At some point, maybe in the next year, maybe in the next 5 years, the stock market will crash again. The headlines will say billions lost in a single day, trillions wiped out from global funds. But millions will read those headlines and they'll all think the same thing. Where did all the money go? Did it just disappear? Did somebody take it? Well, in this video, I'm going to let you know exactly where that 100 billion went. To explain this in a way that makes sense, let's imagine the stock market is a supermarket. Think Sainsbury's, Tesco's, Walmart, basically anything that sells a variety of goods. And those goods, milk, eggs, clothes, are all different stocks. Every supermarket has an inventory or an inventory of stock. And for this example, let's just assume that there are 1 million pints of milk sold across all the stores, and each pint of milk costs £1. So what is the value of the milk market today? 1 million pints times £1 equals 1 million. That is the value of the milk market. Pretty straightforward so far. Now, let's suppose one of the supermarkets, probably Aldi, decides to drop the price of a pint of milk to 80p. All the other supermarkets get together and think, well, we can't keep our prices at £1. Nobody will buy from us. So they decide to price match. And now all of the supermarkets sell a pint of milk for 80p. But remember, there are still 1 million pints of milk for sale across all the stores. So what is the new valuation of the milk market? Some quick maths will tell us that it's 1 million times 80p, which is £800,000. That's the new value. And just like that, £200,000 gone into the abyss. Except it never really existed in the first place. Think about it like this. The £1 price tag that supermarkets put on milk was just an expected value. They believed that they could sell a pint of milk for £1 because that's the price that people were willing to pay for it at the time. But until people actually go out and buy milk for £1, there was no proof that the expected price was correct. The proof's in the pudding, or in this case, the purchase price. The market revalued the price of milk to 80p. Expectations changed. And in that reevaluation process, no actual money changed hands. Now let's transfer this exact example back to the stock market. If 100 billion is lost due to the value of shares falling, all that means is that people are no longer willing to pay the higher price. What then happens is that there's a repricing to match the new expectation. And the new expectation is the price people are prepared to pay for any given stock. Think of it like the number of shares times the last price someone was willing to pay for it. That's it. Value is simply an estimation of supply, demand, and expectation. Let's bring this all back to where the money goes. I hope you can start to see that the actual stock market value has very little to do with how much physical money is in a bank. The value of a stock is more a measure of hope and expectation. If all available stock was sold at the expected price, only then is the money realized on someone's bank balance. As I said, value is just an educated guess based on a number of factors, with the main one being, is someone willing to pay that price for that stock? And what does this look like in a market crash? Well, the people that hold the shares that have now fallen in value only make a loss if they put those shares up for sale. If they hold the shares, then technically they haven't made a loss. Now let's take this back to the supermarket analogy. Like we said before, milk has been repriced to 80p a pint, meaning that the supermarkets will make a 20p loss. But this is important. They only make that loss on the pints that are actually sold. Imagine over the next day or two, people are scrambling to the supermarkets to buy milk. They can use that demand to put their prices back up to £1 and restore their expected value. The actual loss made by the supermarkets may have been relatively small, but you bet the milk market headline would have read £200,000 wiped out overnight. And this is the key thing you need to remember. Markets are not built on fixed prices. They're built on confidence. And that's a feeling I'm sure we can all understand. Some days you feel extremely confident. Other days, not so hot. It's a feeling that fluctuates day to day. But remember this, there's a general correlation between the two. When confidence is high, value generally goes up because people are prepared to pay the higher price. When confidence is low, prices tend to fall due to the uncertainty that people are feeling at the time. The same way the price of milk can change at the supermarket, so too can the price of a stock. And the stock market is designed in a way that share prices can move very fast at multiple points throughout the day. That sense of urgency and panic can be the fuel to ignite real loss. If people decide to sell all at the exact same time, that can lead to real cash losses. We can look back at history, 1929, 1987, 2008, all massive market crashes with very real losses, but only for those people that decided to sell their shares at the new lower value that people were prepared to buy them for. Now let's go back and answer the question right at the top. Where does all the money go during a market crash? And the answer is nowhere. Because the 100 billion that was wiped out the stock market never really existed in the first place. All that happened was that the shares available on the market were listed at the wrong price, or rather, at a price that no one was willing to pay for. Market crashes are more about emotion, not necessarily the transfer of physical money. There are some out there that will argue it is a transfer of wealth. Those that panic transfer their money to those with patience. But there's a famous quote that goes, "Nothing in this world has a set value. Something is only worth whatever someone else is willing to pay for it." And on that note, I'll catch you in the next one, guys.